After years of record-breaking appreciation, property values are finally facing their first test since really 2019, as interest rates are starting to rise actually pretty rapidly and are starting to put downward pressure on housing prices. A lot of investors are wondering, is now a good time to buy? Should I buy now while interest rates are relatively lower than they probably will be in the future, or should I wait and see if the housing market might crash or maybe decline a little bit and buy once prices are lower? This is a super important question, and luckily we can answer this with some pretty simple math, which is what I'm going to show you all how to do today using the BiggerPockets calculators. It's super easy, and at the end of this video, you'll be able to answer this question: should you buy now or wait, for yourself. Hey everyone, I'm Dave Meyer, Vice President of Data and Analytics at BiggerPockets, and I am super excited to show you how to answer this all-important question today. But before we jump into it, I do have a request for you. If you watch my videos every week and like this kind of data-focused, news-focused content, go check out my new podcast and YouTube channel. It is called On the Market, and you can find it in the link below. It is made by BiggerPockets, and please subscribe to that channel so you can get all of the news and data videos that I'm putting out, as well as Henry Washington, James Daynard, Jamil Damji, and Kathy Fecky are all going to be putting out news and current event related information on the new On the Market channel. Before you do anything else, give us a thumbs up and go subscribe to that YouTube channel. Okay, so let's jump into this question. Should you buy now or should you wait? And for this question, there are essentially two variables that you need to think about. The first are, of course, home prices or property values. And the second is interest rates, because those are the two things that are really at play here. Because if interest rates go up, even if prices go down, your mortgage payment might be more expensive. So there's sort of this balance between interest rates and housing prices, and that's exactly what we're going to look into today. So for the purposes of this video, I'm basically going to take two scenarios and I'm going to analyze both of them, and then we'll look at the results. So the first result is basically buying today in April 2022, where interest rates for an investor are somewhere around 5%. Of course, things are changing rapidly, so depending on when you watch this video, it might change, but the underlying math and analysis is the same here. And at the end of this video, again, you'll be able to do this analysis for yourself. So even if things change, this should be applicable to you. But for the purposes of this video, I'm going to use a 5% interest rate, and I'm going to use roughly the median home price in the US right now, which is about $400,000. So those are the main two inputs that I'm going to put in. I'll show you the other inputs in just a minute, but those are the main two things that I'm thinking about. The second scenario is going to be what I'm calling the crash scenario. And this is a 10% decrease in prices. And that's going to happen sometime towards the end of the year. And that crash, in my mind, is likely, if it's going to happen, which again, I'm not sure it's going to, I don't actually think it's going to, but if there is a crash, it's probably going to be brought on by rising interest rates. So in scenario two, we're going to have housing prices that drop 10% down to 360,000, but interest rates are up at 5.75%. So those are the two scenarios. One is buy now, 400,000 for the house at a 5% interest rate, or scenario two is buy at 360,000 and a 5.75 interest rate. Before we jump into this, I just want to be clear that I don't necessarily think there's going to be a crash. I personally believe that housing prices are probably going to go flat and might even decrease a little bit at some point in the next 1 or 2 years, but I don't know when. And I don't think anything more than 10% is very likely. It could definitely happen. But if you looked at some of my other videos, historically, it is very rare that housing prices go down over 10%. In fact, only one time in my research in the Great Recession is the only time I've ever seen it go down more than 10%. So just keep that in mind. But I do want to sort of give you two different extremes, right? Buying now, or what I think is not the worst case scenario, but is a bad scenario where prices go down 10%. So let's dig into each of those. And for that, I'm going to turn to the BiggerPockets calculators to help me analyze these deals. Okay, so I'm using the BiggerPockets rental calculator, which is available for pro members in an unlimited fashion. But if you're just a free member, you can use these calculators 5 times for free. So you can check this out on your own, even if you are not a pro member. What I did was walk through the simple calculator usage. I put in a fake address, Data Deli Way. And the purchase again is $400,000, and I'm just estimating closing cost for $7,000. I put property value growth at 3%, and that's because even if the housing market declines in the coming years, I personally believe that the housing market is poised for very strong long-term growth, even if things are a little fuzzy over the next couple of years. And so I'm putting 3% there. That's barely above average, so I think that is a very conservative estimate. Next, I'm going to put in loan details. Most investors put 25% down on their loan, so that's what I'm going to put here. And I'm using, again, an interest rate of 5%, as we discussed, on a 30-year fixed rate loan. Next, for rental income, I estimated about $2,800 per month. This is similar to some properties that I've been looking at recently, so I'm just using that. And income growth, rent, I'm going to put at 2%. We've seen rent rising like crazy, and I actually think it's going to rise this year at a pretty aggressive rate, but I'm just going to put 2%. That's a little bit more conservative. And then for expenses, I actually looked up some property taxes and insurance for a real property, put them in there, 5% for repairs and maintenance, vacancy, 8% for management fee. The expenses don't really matter because they're staying the same for the house, right? So it's not a huge concern what these are, but I just wanted to show you all the assumptions that I'm making. But then using the wonderful BiggerPockets calculator, all I do is hit update analysis. I've already done this before, so it's not thinking too hard, but I just wanted to show you. So what you can see here is this is scenario one. So buying now, if you bought this deal, you would have $370 of cash flow. It's pretty good. Cash on cash return of 4%. And I know a lot of people out there probably think that that's not that good. Personally, I would be happy with a deal like that. I look for places where there's good appreciation and where it can get at least a 2 to 4% cash on cash return in case anything goes bad. But this to me is a decent deal, especially in today's market. So you can see here that we'd have an annualized return of 15.6%. But really what I want to show you guys is all the way down here at the bottom where we model out different scenarios over time. And I don't know why, I just picked 10 years. I think that's a nice round number. So I'm going to compare the scenarios at the 10-year mark. It really doesn't make much of a difference. But at 10 years here, you can see that the profit it's sold is $267,000, which is great. That would be great after 10 years. And our annualized return is 13.3%. So just keep those in mind. Profit if sold, 267 grand. Annualized return, 13%. All right, now I am going to go to the next. Scenario, which is scenario 2 here, which is the price drop. So as you can see, the cash flow is increased for $454,000. So we were at 370, just as a reminder. And now we're at 454. So that's great in terms of cash flow. But if you and a higher cash on cash return with 5.62. So both of those are better. But if you come down here and look at the profit is actually less. It's actually $245K instead of $267. And the reason there is simple, because I put a 3% appreciation rate on a higher priced property in scenario 1. So the value of the property goes up much higher. If we go back to scenario 1, you'll see that the value of the property over 10 years went to $538. And in scenario 2, it went just to $484. So that's the big difference in the profit and why scenario 1 has $22,000 more of profit. Scenario 2, however, has a slightly higher annualized return. See, we have a 13.44% annualized return here in scenario 2, but in scenario 1, we were at 13.33. So there's not a huge difference on either one. And that's what I really wanted to show you guys. And honestly, if you think I doctored this so that they were really close, I really didn't. I honestly just thought a 10% drop seems like a pretty big drop to me. And I think interest rates are going to go up 0.75 of a point over the course of this year. So I made this up and look, it's exactly the same. To me, what this signifies that these two deals and these two scenarios are so close is that when you find a good deal, you should just pounce on it, because whether you wait or whether you do it now, you're going to have a similar rate of return. And as investors say, time in the market is more important than timing the market. I'm going to share with you the 3 reasons why I am still investing right now. And of course, this is just me. These is my read of the market. This is my risk tolerance, but these are the 3 reasons why I am still looking to buy right now. First of all, I don't think a 10% drop is likely. I think we're more likely to see something like a 5% drop. And in that scenario, you actually get the worst of the 3 returns because the price decline is not enough to offset the rising interest rates. So if you compare what I think is more likely, which is like a 5% drop sometime in the next 2 years, to investing right now actually is a better return because interest rates are going to be lower. So that is number 1 reason. The second reason is, as I said at the beginning of this article, there's basically 2 variables that you need to control for. One is interest rates and one are property prices. But frankly, no one knows what's going to happen with property prices. I like to guess and come up with hypotheses about what might happen, but I don't really know. I have an informed opinion, but it's really pretty cloudy out there for what's going to happen with property prices. The other variable, though, interest rates, is pretty clear. Like, they're going up. The Fed has said they're going to keep raising rates. Bond rates keep going up. And those are the 2 things that drive mortgage rates upward. So I feel very confident that we are going to see mortgage rates continue to increase over the rest of this year. So I like to make my decisions based on the variables I know as much as possible, and that's interest rates. And so I would like to lock in a lower interest rate if I can. And the third reason I am buying right now is because all 3 of these scenarios, whether you buy now, if you prices drop 10%, prices drop 5%, all of them, in my opinion, are better than any other asset classes. With inflation right now, your cash is losing more than 8% year over year. So cash is trash. It is not good to hold on to a lot of cash right now. Bonds have a negative real interest rate, which means that they don't even keep up with inflation. So that's not a very attractive option to me either. I do invest in the stock market, but it's very volatile right now. And I don't frankly know enough about cryptocurrency to put a large portion of my net worth into that. So for me, it's real estate. And of course, I'm biased because I know the most about real estate, but what I'm sharing with you right now is reasons I'm still buying real estate. And to me, I don't see any other assets being desirable, and real estate still is really desirable to me. Okay, so that is it. If you are interested in doing this for yourself, you probably have different assumptions than I do. Maybe you think interest rates are going to go slower or faster than I do. Prices, maybe you think it's going to go down 20% or go up 20%. But hopefully you can see now using the BiggerPockets calculators, it's super easy for you to make this decision for yourself. Guys, if you like this video, I please ask, it would be a huge favor to me if you went to On the Market's YouTube channel, subscribed, watched a couple videos over there. We think you're really going to like all the content we're putting out. If you like this kind of content, you're going to like that. If you have any feedback for me, please hit me up on Instagram where I am @the Data Deli. If not, I'll see you over on the Market channel sometime soon. Thanks.